Hello, everyone. Welcome to today's class. We'll be looking at some of the key things on the chart today. Most of you have been asking when are we going to go into the charts? When are we going to learn trading and all that? So, my approach is that I would say spend more time understanding the chart before trading. Like, trading should not be your focus. I know most of you want to make a quick bucks. You're like, okay, I need to get into trading right away. No, that's not the right approach. Understand the charts, know what it means, understand what you are doing before going into the charts. Of course, today we're going to be looking at the charts and explaining one by one, see what this means, what this represents. If you have questions, put it in the chat. That's why we're here. And I will do my best to answer them. If I can't answer them, well, we have other people in the comment section here in the chat that may be more knowledgeable. They can contribute as well. So thank you. Let's dive right into it. So let me share my screen. Let's see what we got here. Okay. Screen. Okay, can you all see my screen? Good. So you are looking at the charts, and I don't know what comes to your mind when you see the chart. What comes to your mind? I think the first thing would be to zoom out. There's a BTC, Bitcoin chart right now. So the first thing would be to zoom out and look at the big picture, where things are, so that you can understand probably what's going on. Because if you don't zoom out, if you don't see the big picture, you'll be confused. The big picture provides that clarity so that you know what's going on in the chart. So I think the key thing is to understand the time frames. So what does that mean? They represent uh, the period of price movement or fluctuation. So it could be you're looking at the 1 minute or 5 minutes or 15 minutes, 30 minutes, an hour, 4 hour, or daily time frame. Now, here, the time frames are represented by time. So if you go on the chart, you see time. So this is the 15 minutes time frame. You can see here, if you are following, you go here, you see charts, then here on the chart, you see time. Then you're going to see the time frame here. We have 1 second, 15 minutes, 1 hour, for 1 day and 1 week. And you can edit, and also if there is a particular time frame that you want to add, you can actually do it yourself. Say, okay, I want a 20 minutes. 20 minutes is not very regular, right? We do 15 and 30, but you can say, oh, I want to see a 20-minute time frame. What does that look like? You can put it there and add your own. So that's that. But for now, let's just keep it with the standard. So 15 minutes, that's where we are. Now, this is the original view. We're going to go into the trading view side. So you click here, trading view. Okay, now it's on trading view. So over here, is same thing. They're going to see the time, 15, an hour, 4 hour, 1 day, and 1 week. Now, I'm going to be changing the time frame so that we see how it looks. I can remove this one. Can make this full. Okay. So if I change it to 1 hour, you're going to see the pattern for 1 hour. I want to change that to 4 hour. So this 4 hour chart, you can see. Now, but the big picture actually comes from one day. So one day, you can now see that, oh, look at where things are. Wow. So all the way from here, around 18,000, running up all the way to 126, and now back to 89. So you zoom out. When you zoom out on the bigger time frame, then you have a bigger picture. Same thing with the weekly. You want to go on the weekly charts, change it to the weekly. You can say, oh, okay, look at where we are on the weekly. So that will help you. This approach is called the top-down approach. Top-down approach. So you see, you have the eagle's eye view, that 40-foot view. You can see things from above. You can see what's going on. So that's the weekly chart. You can even change to the monthly if you want. There's a monthly here. Let's do the monthly. So look at the monthly chart. Look at that. So you have a lot of few candles because it's on a monthly chart, right? So let's go back to 15 minutes. 15 minutes time frame. So it tells you what happens for each of the candle. So these things are called candles. These are called candles. And for the candle, you see the body of the candle and you see the wick or the shadow of the candle. So the body of the candle kind of tells you the whole story, like the summary of what happens in the market or what happens to that particular time frame. So this is a 15-minute candle. So in this 15 minutes, for instance, for this one, this 15 minutes, let's back up a little bit. Why is the candle red and why is it green? So it's green if there was a gain in price in that particular time frame. So if it's red, then it means the opposite. So here you can see that the price opened at about 89. If you click on the candle, you don't click, just hover on the candle like this. Then the information will be displayed on top. So you see these values here, they change corresponding to the candle. So if I hover on this candle, just hovering the mouse around this area, you're going to see the information here. So I'm going to see the time. I'm going to see the value at which it's open, the high, the low, the closing of that candle. And that will help me to make a decision. So you see, yeah. So if the price reduces, let's say it opened at here, the open was it open in this candle? About 89, 89.6. Or you see, close around 88, 88.9. So in that case, 88.926. You see that there was a reduction in price, a more than $700 reduction. And if it's green, it means there was an increase in price. So the time frames, they are very critical. They're very important that you understand this. Very important. And the last video that we did, we explained what it means for you to do your own research. And that is on the fundamental side. So that's the fundamentals, right? You are looking at the white paper and the idea. Now, what's this idea about? What's this cryptocurrency about? Either it's a coin or a token. You look at the idea and the white paper. Another thing was that we listed was the team. So yeah, the team, what's the team behind it? Are they credible? Are they reliable? Are they transparent? So look at the team. Have they done something like this before? Is this their first time? Do they have a track record? And look at the tokenomics. The supply, demand, supply of the token, supply and distribution of the token. How much is being produced? How much is currently in circulation? Is it capped? Not capped? What does that look like? What's the timeline? So look at that and look at the competition. Is there someone else that is doing this particular thing already in the market? look at the competition, and look at the community. So all these things that I have listed now, they are on the fundamental side. So the fundamental analysis. And when it comes to technical analysis, you are looking at the charts. You're looking at the charts. You're more concerned about the charts. You're more concerned about what's going on. What's going on in the chart? Let's dive into the chart. That's the technical analysis aspect of it. So time frames. So I've explained that to you. Explain what happened in between the period that is selected. So if you select 15 minutes, it tells you what happens in that 15 minutes. You select an hour, like here, 1 hour candle. You can see what is happening in the hour. And also for the 4 hour, we see what is happening for the 4 hour. That's the time frames. You can zoom in and zoom out. And this is trading view. So this chart is actually, I think it's imported from trading view, although it's on a Binance exchange, but that's trading view. So how about this area? What do they mean? All these things here. So these ones represent the line. The line. You want to draw a line on the chart, you just click on it. You can draw a line here. See here. You can draw a line. Okay. And we'll draw two lines, same thing. Can draw another line here. So it's in two lines. Okay, so now that's a channel. There's a wedge, and it's called a falling wedge. I'll go into that later on, but for now, let's just stick with the basics. This is a falling wedge. When you see this, you know that there's a correction in place, but it breaks about 70% of the time. It breaks to the upside. That means it's showing that there will soon be a reversal, especially at this point. When the price hits the bottom of the wedge, that is a good entry zone. Okay, let's move on. We can say, so how about this? This one's under. So that's the volume. The volume tells you the amount of transaction taking place within those candles. So we have like this. Look at this big volume here, big boy. Look at this spike. That's a huge volume. So that means that on this dump on October, when was this? Yeah, October 25th. No, October 10, 2025. There was a huge dump in the market. So that means a lot of people were selling. Look at this, look at the volume. That tells a very good story. Just from the volume alone, you can, without looking at this upside, just with this volume, you know that something abnormal happened. Like, oh, something is off here. What happened? Like you can start asking the questions. What happened here? Because the volume is abnormal. Look at the range, the heights of all the volumes here. But this is way above. It's like an outlier. So when you see an outlier like this, then you can investigate. So what happened? And we can see that in the market, there was a huge dump that day. Okay. What are these lines? What do they represent? These are called moving average. So that's a moving average line. Let me take them off and say hide. Yeah, I think here. Say hide or okay, go back. Show drawings, hide options, hide indicators. So you see, hide indicators. Now they're hidden. Hide the drawings, or just hide everything. So let's take out the drawings from here. And just delete them. Delete, delete them. Okay. And over here, there's the weekly, that's the 15-minute time frame. Okay, so let's go over this. The moving average. What do they represent? So, of course, you know the word average. Average of five numbers is just the sum of the five numbers, divided by five. That's the average. Average of 10, the same thing. Add the 10 numbers, divided by 10. So for the time frames that you are on, so now we are on the 15 minutes time frame. And you're going to see here MA7. So moving average 7. It means the average of the last seven candles on the 15 minutes time frame. So the last seven closes. Every 15 minutes, another candle is formed here because we are the 15 minutes time frame. So if you add the prices of the previous seven, you add their prices, the closing price of the previous seven candles, and divide that by seven, then you're going to have the value here. That will give you the value of that moving average 7. That's why you see here 7. Now, same thing. You see moving average 25. That means 25 candles. Moving average 99. That means 99 candles. When it comes to moving average, the key is that you don't add, 1,000 moving average on the chart. It's going to confuse you, right? So you don't want to have, like, the moment you see a chart that is crowded, there is so much moving averages here and there, or too many indicators, then there's confusion. You want a simple chart, a clean chart, so that you have clarity of what you're doing. Now go back here. These are technical indicators. That's where you have the moving average and other indicators that will tell you what's going on. Here we have. So, one thing before we continue is that the indicators, they are like two types, or in two categories, not two types. They are different indicators, a lot of them. But we have the leading indicators and we have the lagging indicators. So the leading indicators will tell you, they predict where the price is going. So that's they predict the price, or they predict what's going to happen. For instance, the resistivity, the relative strength index, rather, sorry, RSI, the relative strength index, or the stochastic RSI. So they predict what's going on, what's going to happen, or even the MACD. I think the MACD also predicts. But I think the one that is mostly used is the RSI and the stochastic RSI, those two. So for the moving average, if I want to add a new one, I can come over here, go to the indicators here, and click on, just type moving average. You're going to see them come up. Moving average. So here, moving average. So you click. So now we have a new moving average on the chart. So it's this one. Now I want to change the value of that moving average, so that, because now it's showing the 9 moving average. I don't want to see the 9. I want to see the 50 moving average. So what do? So you go here, go on settings, and then you're going to see the length here. So I want you to track the last 50 closes. So enter 50 here. And for visibility or the style, I'm going to change the color so that it be more visible. So let's go with these. Okay. Average. Go with that. Inputs, and just say okay. So now you see I have the 50 moving average now here, light blue. Okay. Um, then I can remove any of the indicators that I don't want to see or I don't like the 99 moving average. Okay, I don't want to see that one, or I don't like it. I'm gonna just delete it from here. So just click delete. How about the 25? I can keep it, 50 moving average. I just added that one. Then I can also add the 200 moving average. So you go same thing, just go to the indicator. So look for the moving average here. Then you just edit to the 200. So here it is. Go to settings, change the length to 200. Now I will explain why we want to use the 200 here. And okay, which color are we going to use for the 200? Let's go with okay, purple. No, I don't like that one. I will just go with the white color here to make it more visible. Okay, yeah, say okay. So we have the 200 moving average here. We have the 50 moving average. Now, these two moving average, the 50 and the 200, they are very important. Why? Because they tell a very good story where the market is going. So if the 50 moving average at any time crosses the 200 moving average upward, and that means we are entering into a bullish market. So that's a golden cross. Golden cross. If it crosses upward like this, it's a golden. So we're going to look at example on the chart. So let's go to the daily chart. So go to the daily. Remember the light one here is a 200 moving average, while there's light one. No, this is 200. Yeah, this is the 50. Good. Okay. So can you see this? Can you see this? Very good picture. So at the cross here, the 50 crosses the 200 below. So that's not a good sign. Now let's go to the weekly. Sorry, and that's what I was looking for. Yes, it's a weekly chart, right? Okay. So this way you have the golden cross and all that. So anytime the 50 moving average crosses the 200 to the upside, like here, let's zoom out. Let's go back the big screen. Zoom out here. So you can see this cross here, right here, around I think around 30,000. Yeah, around 30,000. So this was a clear indication that you are entering into a bullish zone. That means more upside. Look at it. We have the 200 moving average here. We have the 50 moving average here, and they cross at this point. So the price here was around 41,000, or let's just say 42,000. 42,000. So there's a golden cross. When you see this, let's look at a line. Push. So at this point, where is it? Right here. Oh no, yeah. So right here we have the golden cross. Here, golden cross. You can add a text. What is the text? Let's see. You can draw. So here you have your golden cross. Let's change the color to a brighter one. The color. Yeah. Okay. So yeah, that's a golden cross right here. Now the opposite of a golden cross is a dead cross. If it flips and it crosses to the other side, then it means danger. So that's not good. When you say a dead cross, it means you should run. Here. Oh no. Here. I'll just move that up. You can see here. It was telling you the direction of the market is changing. It's changing from a bullish market to a bearish market. That means a market of a moment or a period of price drop, bearish market. So here at this cross, you already know what's the price around 40,000. You say, okay, no, I'm seeing some signs on the chart and it's not looking good. Why? How do I know that? Because the moving average just crossed. Now, one thing you should have bear in mind is that you can't make a decision based on one indicator alone. You need a confluence, an agreement. So you're using your moving average, you are looking at the volume, you're looking at uh, relative strength index, the RSI, or you're looking at the stochastic RSI, but not just one. It has to be a combination, two or three indicators. Okay. So we have, yeah. So here, dead cross. So let's go here. Point to spread. No. Brush. So let's add a text to this. Yeah, text. So here we have the dead cross. So not a good sign. When you see that, not a good sign at all. Fine. Oh no, let's remove that one. Delete. So this zone, yeah. So there's a cross here. Not good. Here too, there's a cross, but this is the type of cross that we like. There's the one that will, this is what we want to see. This type of cross. Upside. This one, downside. Now something that is forming on this chart. Something that is forming. Oh no, delete. Okay. Oh no, delete. Go to line. Delete. So something is forming here. I want you to see something is forming. So over here, if we look at the chart again, so remember what we just learned here about dead cross, meaning there will be a period of continuous price drop. The moment the 50 moving average crosses below the 200 moving average, just like we saw it here in 2022. Can you see here? 2022 April. 2022 April. Look at it here. So, and of course, you know what happened. Look at it. The price drop from, was it a 42,000 or so? Yeah, about 42,000 all the way to 16 or 17,000 thereabout. Yeah, 17,000 thereabout. Now, here, when there was a cross here, the golden cross, the price rallied up from 42,000 all the way to 126,000. So 42,000 all the way, and this was the cross was in January of 24. January of 2024, the price, the golden cross, January 2024. And the price rallied all the way from 42,000 to 126,000. So that's more, yeah, that's 3x, right? Now, look at what is happening now. Look at what is happening. Can you see what is happening? Can you see what is happening here? This is the 200 again. This is the 50 moving average. Can you see what is going on? Have you seen that before? Look at 2022. Have you seen this picture before? Let's delete all this noise on the chart. Okay, let's take this out. Take this out. Can you see this? Can you see this? Across April 2022, the 50 moving average crossed down below the 200, and price dropped from 41,000 to 17,000 or 16,000 thereabout. Now, fast forward to 2026. Something is about to happen here. What am I saying? I don't know, but something is about to happen. So if you go back here to line, no, let's go to line. No, go to brush. Arrow marker. Brush. Okay. So here, I'm just drawing the line, extending it. So this is around when, if this happens, now let's change. Now there's another line here, 50. If this happens, just like here, can you see 2022, this zone, this area? Now, if this happens here, what does that say about the price? So it means that you're going to have something like this. You're going to see something like this. I'm not saying it's going to happen. I'm just giving you an example. You're going to see something like this. Woo. So look at that. Look at that. Now we are what, 90,000 thereabout, and it's saying, oh, maybe this is too dramatic. 62,000. Okay, you know what? Let's delete this. Delete this one. Delete. Hey, why are you not deleting? Remove. Delete. Okay. This. Let's delete this. Okay. And if you go back here, go to brush again. So maybe something like this. And then again, so here, and then yeah, and then this could extend all the way to here. So yeah, the bottom line is that it's not looking very good, because this will be a dead cross. And every time you have a dead cross, well, not every time, but most of the time when you have a dead cross, it's not good. It's telling you that there's going to be a period of continuous price drop, price decline in the market. So it's going to drop from the year, from here. Okay, but keep dropping for a long time. So this is just an estimation and projection. It doesn't mean it's going to happen this way. It's just an analysis. So, but ignore the chart and pay for it later. So you don't want to ignore the chart, right? You want to understand what's going on. You want to learn what's going on. And so yeah, that's just one indicator that we are using there. And before you, and it's always good to use two or three indicators so that you have an agreement, because this is one, all right? What if it's off? What is just, you know, behaving in a weird way and it's not actually telling the whole story? So we need someone to confirm. We need two or three people. So here, two or three indicators to confirm what's going on. So we can now use the RSI or stochastic RSI. So we can add that. Say I can go here and say, okay, I want to see an RSI on this chart. So RSI, relative strength index. Or I can use the stochastic. I can add the stochastic as well. So here, look at both of them now. So look at the stochastic RSI. So what is it telling me now? RSI struggles below the midpoint 50 zone. So, and it's kind of looking downward. Not good. Not a good sign. Now, how about the stochastic one? It's kind of pointing upward. Both of them are upward, but it's losing steam, looking as if, oh, I'm struggling to climb this. Can you help me? So when you see that, that's not a good sign too. So there seems to be an agreement between the stochastic and the moving, the RSI and the moving averages. When you see an agreement like that, then you can decide on what to do. Okay, so that's what's all this. Let's delete this on the chat. Delete. Delete. Yeah. Okay, so now I hope you understand the time frames, what they represent, and how that helps you. I hope that will help you, and remember the difference between the fundamentals that we did the last time, looking at the white paper, the idea, the team, tokenomics, the competition, the community, and then so those are fundamentals. Now, by the time you go into the charts, you are looking at the technical analysis. So these are the technical analysis, and the fundamentals tells you what is it about. The technical piece tells you the when, kind of a timing issue. So explains the when, whereas the other one explains the what. So know the difference. Okay. If you have any questions, you can put it in the chat before we round up for today. Next time we will explain. We'll have more indicators to explain them, and we also look at the patterns, chart patterns, price action, what's going on here with the candlesticks, and also market structures. When it's sustained, when it's broken. We also look at support and resistance levels, channels, wedges, all that. So that will be in the next class. So now I hope you understand what the moving averages are for, and how we get them. So I explained the average is just the sum of the numbers divided by the units. So if it's 5, add the five numbers divided by five, right? Um, that's how you have these moving averages. And there's when it comes to moving average, there's another indicator that's called the exponential moving average. The exponential moving average that gives more weight to more recent prices, because for the moving average, for instance, um, this 200 moving average is the average of the candles. Now we are on the weekly chart, right? So for the it's calculating for the last 200 weeks, but this one is up to uh, 50, yeah, yeah. The 200 moving average on the weekly chart calculates the average of the candle, the closes for the last 200 weeks. Now it's going to just level that number, right? So we say, oh, the average is what? For instance, here it's showing about 57,000. But if we want we want it to reflect more recent price change, then we can use what we call the exponential moving average. So if you go on the technical, you can just say the exponential moving average. Then we can change to the 200 exponential moving average. And how about the color? So let's change the color. So please, we have this, yeah, this green color. No, that one's not good. How about this one? No. Yeah, okay, let's use this. Okay. So look at this. Now pay attention here. The exponential moving average gives more weight to the recent price movement. If you look here from uh, January of 2024, you can see that we've had prices more on the upside, so above 40,000 value, right? So you can see that the the exponential moving average is giving more weight to recent price movement, right? So the recent prices have been on the upside: 40,000, 50, 70, 80, 100, 120, 126. So it's more on the higher side. Whereas if you go down here, see the prices, you can see 30,000, you can even see 20,000, you can see 16,000, like that. Of course, there were some 60,000 here, but it will average on the low, right? Because these are few prices, whereas so we have more weeks of this. So that's why you see the difference. This the moving average alone for the 200 is showing about 57, whereas for the exponential that gives more weight to the recent price is showing about 68,000. So that's the difference. Now, if you want to see more recent price changes, then you can use the exponential. But if you are just, what, I want to see across the board, the longer period, longer time frame, then you're good with the moving average. Okay, you can put your question in the chat or put in the comment section if you have any. And by the next class, when we come back, we will deal with those questions, or I can just respond to them directly. So for now, we're going to stop here for today. Thank you so much. God bless you. I hope you've learned something, though. That's the whole purpose of skilling, to provide the education that you need, the knowledge, right? The skills, so that you know what's going on and can make your own decisions. Thank you and have a good one. If you have any question, like I said, put it in the chat and I will address it. Thank you.